Hi, my name is Justin Lake from Think Numbers. Today we're going to be talking about a question around capitalizing assets and calculating annual depreciation. So in this question, this is a situation about Jimmy Jones, and he's actually bought a truck and made the following cash payments when he purchased the truck. So initially he made a $50,000 upfront deposit. When the truck was actually ready, he made a $250,000 payment for the base remainder of the truck that he ordered. He then made some additional upgrades and got a crane rig installed on the truck, and that was an additional $25,000. And there were actually $5,000 in stamp duty and delivery charges that also needed to be paid when the truck was actually delivered. So the question is, determine the cost base and calculate the annual depreciation of this truck, assuming a 10-year useful life and a scrap value of $30,000. So the first thing to understand about depreciation, what is depreciation firstly? So firstly, what you actually do is you capitalize the cost of the asset and you put it on the balance sheet under property, plant, and equipment. And then you can actually depreciate this over a period of time, in which case you can depreciate this over a 10-year period, in which case what that means is the actual cost of that particular truck is going to be written into the profit and loss statement on an annual basis based on the useful life. And in order to calculate depreciation, you need to work out your cost minus your scrap value or residual, and what that is the amount that you can actually sell it for at the end, and then you divide it by your useful life. And useful life is the estimate of how long that asset will last. And there are actually some guidelines under different accounting standards of what those useful lives are, as well as for tax purposes. There's actually guidelines around what this should be. Now, when you've got a whole lot of different payments made, that doesn't mean that you need to depreciate every single component. Generally, the way it works with capitalizing fixed assets is you might have a number of different costs, but then when the cost is actually ready for delivery, the truck is ready for delivery, you can actually lump all of these costs together and actually treat them as one cost. So in which case, even though the deposit was made up front, the $50,000, you're not going to actually capitalize that initially because the truck's not actually ready. When the truck is actually ready itself, you're going to also need to add the $250,000 to the cost base, because when that truck's actually ready, you're going to need, it costs $300,000 to actually make that truck, and therefore that needs to be included in the cost base. Now, this crane is actually part of the truck, so I would also be adding that to the cost of that truck. And then finally, the additional charges to register it for the stamp duty and any kind of delivery charges also need to be factored in, because that's actually the cost of acquiring that truck and getting it ready for delivery. So as a rule of thumb, the cost you will have a cost base when an item is ready for delivery and ready for use. In which case, let's assume in this example that these were all the charges you needed to pay for when the truck was actually delivered. Okay, so if we add that up, we actually get $330,000 is what it actually cost us to get this truck produced and ready for service. And so we've got $330,000. And what we're going to do is we're going to take off the scrap value. So we believe that after 10 years, we're going to be able to sell this for $30,000. And the reason why we want to do this is because we actually want to write this down over the next 10 years until we hit $30,000. And at that point, we believe we're going to sell it for $30,000. So therefore, we sell it for $30,000 and our book value will be $30,000. Therefore, there will be no gain or loss on sale. We're just going to get exactly what we believe it's going to be worth. And if we did sell it for more than what $30,000 is, then you'll make a profit or gain on sale. And if you sold it for less at the end of the 10 years for the $30,000, then you would have to write that off on your balance sheet. So once you actually work out that amount for the cost minus the scrap value, we're going to divide it by a useful life of 10 years. And we're going to get a $30,000 annual depreciation. And so that's how you calculate depreciation. If this was then on a monthly basis, you could divide that number by 12 to actually post a monthly depreciation charge for this particular truck. But that is how you calculate depreciation using the straight line method of depreciation. I hope you've enjoyed this lecture today. Please feel free to subscribe to my channel and check out many other videos on accounting concepts.